Hi guys, it's good to see you again. Hope you've been well, hope you've been enjoying the lectures and the tutorials and all the recordings so far. It's been nice. Okay, right, so here we go with week 10. And we'll go over the tutorial questions. Of course, you will have the chance to go over these in your tutorial classes. So this is just a little extra. All right, so question 1, the difference between gross domestic product and gross national product is, of course, we know this is the net property income from abroad or net income from abroad, okay? So that is the closest answer there. And 1, the answer is B, okay? For 1, the answer is B there. For question number 2, it says the difference between gross national product and the net national product is, we know that is depreciation. Also, the difference between GNP and NNP is depreciation, okay? Let me just write those on the board. So for 1, so we had GDP minus GNP, and we know that is net income from abroad, okay? From abroad, okay? And in this case, we said property because that's the closest we have there. All right, and for 2, we have the difference between GNP and NNP. Okay, so gross national product versus net national product, and the answer there, ladies and gentlemen, is depreciation. Okay, I can't get no depreciation. And then GDP per capita means what? GDP per capita, ladies and gentlemen, is just GDP divided by the population. So it is GDP per person, okay? Per capita, okay? So that's GDP per person. All right, so there we have it. So 4, equilibrium in the economy occurs when, we know the answer has to be C, when planned injections, not the type you get from the doctor or the nurse, equals planned withdrawals, okay? Then you have the economy being in equilibrium. 5, injections into the economy do not include, there we have savings, okay? Investments are injections into the economy. Government spending is an injection into the economy. And when we export, we get paid. So that's an injection into the economy. And then we have number 6. In the circular flow of income model, injections into the economy, we have the right answer being are not assumed to be linked to the level of income, okay? So in the circular flow of income, model injections into the economy, the answer for number 6 is B, are not assumed to be linked to the level of income, okay? So we're not assuming that injections are linked to the level of income. Now, there's a theoretical debate about this, but for now, that's what we'll stick with at this level of economics, and you discuss this more in your tutorial classes. And then number 7, if planned injections are greater than planned withdrawals, what happens? So we have injections being greater than withdrawals. So we have something like this here. Okay, so we have that for number 7. So what happens in that case? We have aggregate demand will be higher than existing output, okay? Because we have more injections into the economy than we're withdrawing, so we can demand for more goods and services. So aggregate demand is higher than the existing output. Number 8. 8 says if aggregate demand is lower than the level required for full employment, this means there is it's what we call a deflationary gap, okay? So if aggregate demand is lower than the level required for full employment, so there's a level for full employment to employ everyone, full employment, okay? But then you have aggregate demand not reaching that, so aggregate demand is lower than that. So the gap is called a deflationary gap. Okay, so that's what we call that there. Okay, number 9. if the amount of do-it-yourself, DIY, like I like to do some stuff by myself, and I'm pretty good, I tell you. Okay, I'm just messing with you. If the amount of DIY activity increases in an economy instead of employing others to do the work, what will happen? Will national income increase? No. Will the quality of life necessarily be worse? We don't know. But we do know that national income will fall because we're doing the activities ourselves and we don't pay ourselves, right? So instead of hiring a plumber or an electrician, you're doing it yourself. So the income would fall. The income you're supposed to give those people would not be given to them. So national income would fall. Will the economy be worse off? We don't know, but we know national income will fall. And then number 10, the final question in this section says, an example of government policy conflict might be, and we have the answer there being D, an increase in demand leading to less employment and higher prices. So the government might be trying to inject into the economy to stimulate employment, okay? So maybe the government starts a new investment, say HS2, or the construction of a football stadium or whatever. So we have more people having jobs, but because these people have jobs, they have more money to spend. They go out there and spend, and of course, because of this, prices rise, okay? So we have more money chasing fewer goods, so prices will rise. So there you have it, ladies and gentlemen. The answer for 10 is B. But then, of course, we have some optional questions there that we can solve together, okay? So we have some figures. For number 11, we've been told an economy is currently in equilibrium. The following figures refer to elements in its national income account. So we have the accounts in billions of pounds, lots of money, ladies and gentlemen. We have consumption, total, being 60 billion. We have investment, 5 billion. We have government expenditure, being 8 billion. We have imports, okay, we're importing goods and services, 10, and then we have exports, being 7. All right, so the first question says, what is the equilibrium level of national income? So how do we calculate the equilibrium level of national income? So equilibrium level of national income, that's E. Is that clear for you to see? That's an E. Okay, E for Eminem. So we have consumption, that's C, plus investment, plus government expenditure, plus exports minus imports, okay? C plus I plus G plus X minus N, correcto mundo. Thanks a lot. Okay, so what do we have here? We have consumption is 60, we have investment 5, we have government expenditure being 8, we have exports being 7, and then we have imports being 10, minus 10. So what does this give us? This plus this is 65 plus 8, what's that? 73? 73 plus 7, that's 80. That's 80 minus 10, so that will give us 70, okay? So the equilibrium income is 70. J says, what is the level of injection? So injections from the nurse or the doctor, right? In level of injections, injections. So what are injections? Injections are things coming into the economy, right? So they're made up of investments, they're made up of government expenditure, and they're also made up of exports, okay? So in this case, our injections would be 5 plus government expenditure, which is 8, plus, what's the other one? 7, exports, 7, yes. 7. So what does this give us? 5 plus 8 plus 7?
20.
This one's 20. Thank you so much. 20, okay? So there we have it. And what does C says? C says, what is the level of withdrawals in the economy, okay? So because the economy is in equilibrium, remember we said the economy is in equilibrium when planned injections are equal to planned withdrawals. Because the economy is in equilibrium, the withdrawals would be equal to the injections, which is also 20 billion, ladies and gentlemen, okay? We're talking billions, big money here. Homie spends big money and big money only. Okay, so that's what we have there. And then what's question D? Question D says, assuming that tax revenues are 7 billion, how much is the level of savings? Okay, so assuming tax is 7 billion. Okay, so let me create some space here. Really quickly, let me create some space. Space! Do you know that song? Space. Scared or Rock by Mos Def. It's a nice song. Give me some space. Go listen to that song, okay? This Ghetto Rock by Mos Def. Give homie some space. Okay, so what have we been told? We're saying that assuming tax revenues, so tax revenues, 7 billion. Okay? Now, we're told how much is the level of spending. Okay, so withdrawals from the economy, we know withdrawals. So what's going out of the economy? We know it's 20 billion. So we know our level of withdrawals is 20 billion. But withdrawals are made up of certain things. They're made up of savings, taxes, and when we import, we have to pay. So they're made up of imports as well. So we've been told that our taxes are 7, right? We've been told, we know our withdrawals are 20. So remember, our withdrawals are 20. So we know withdrawals are 20. And then
imports are given.
Imports have been given, right? So we know imports are 10, okay? So what's the question? Is the question asking for savings? Okay, if the question is asking, so we need to know what S is. So we know 20 is equals to S plus 17. So S will be equals to 20 minus 17. So our savings, our S would be 3 billion. That's a lot of savings, man. I think I got more than that in my account. I'm sure my bank manager is laughing right now. It's like, that guy doesn't have any. Okay, I'm just joking with you. You have plenty of money. Okay, if national income now rises to 80 billion, okay, if national income now rises to 80 billion, that is E. And as a result, the consumption of domestically produced goods rises to 58 billion. What is the marginal propensity to consume domestically? Okay, how do we calculate the marginal propensity to consume domestically? Okay, it's very simple. Okay, we need to look at the change in consumption domestically divided by the change in income. Okay, so that's all we have to calculate. Right, so what have we been told? We've been told that national income has risen to what? 80 billion?
Yeah.
Okay. So what was the previous national income? That was 70.
Yeah.
Now it's 80. All right. And then we've been told, what about consumption? We said consumption of domestic goods has risen to 58. So we know it's 58. But what was it before? What was consumption before? All right. So before, our consumption was
60 minus imports.
60 minus 10, right?
Yeah.
Okay. So this was our formal consumption. Let me just put that on the board. 60 minus our imports. Okay. We're talking about domestic consumption, right? So domestic consumption, CD. Okay, so total consumption before was 60, but out of that we imported 10, so minus 10. So domestic consumption was 50, right? So now we're going to have 50 here, okay? So that's what we have here. Domestic consumption is 50. Okay, so now we can solve this question. All we need to do is we need to do 58 minus 50, that is 8, divided by 80 minus 70, which is 10. So this gives us 0.8, okay? So our marginal propensity to consume domestically, ladies and gentlemen, is 0.8. So we've solved that question. Now the next question, F, says, what is the value of the multiplier? The value of the multiplier. Can you see here? Is that okay?
Yeah.
Okay. So F, our multiplier, the multiplier effect, remember we talked about that and we had fun with that. So the multiplier is just simply 1/1 minus marginal propensity to consume domestically, right? Which is what we have here, okay? So the multiplier would be that, okay? Right, so what does that give us? That gives us 1/1 minus 0.8, okay, which is 1/0.2. So 1 divided by 0.2, ladies and gentlemen, will give us 5. So our multiplier is 5. That's it there, okay? Perfect, okay, and we just have one more for number 11. So number 11 says, given an initial national 11G says, given an initial level of national income of 80 billion, now assume that spending on exports rises by 4 billion. So spending on exports rises by 4 billion. Spending on investments rises by 1 billion. And government expenditure falls by 2 billion. By how much will national income change? Okay, so what do we have here? Space. Let me see. How about if I do it here?
Yeah.
Is that okay?
Brilliant.
Okay, fantastic. Okay, so what do we have here? We have what is going to happen to our level of injections, okay? So we know what our multiplier is. We've just calculated it. It was 5. Our multiplier was 5, okay? We've seen that here, okay? But now it says a couple of things. It says that spending on exports rises by 5 billion. So what is that? What is that? That's an injection, okay? That's an injection, okay? Spending on exports. There we have it, okay? It's risen by how much? By 4 billion, okay? So our injections, in this case, okay, spending on exports, X here, okay, 4. What else does it tell us? It tells us that spending on investment rises by 1 billion. So investment will rise by 1 billion we have there. And then it says government spending falls by 2 billion. So that's minus 2 here. So what does that give us in total? So total change in injections will be this 1 minus 2 plus 4. And what would that give us? Is that the good value of 3? I smell a 3 coming on. So injections would be 3 billion. But we know that the multiplier in this case is 5. That means national income would rise by 3 billion pounds, because homie's got money like that. Okay, big currency, you get me? Times the multiplier, which is 5. Okay, so national income is going to rise by how much? Is that 15? 15 billion. Okay. Correcto mundo, ladies and gentlemen. You did that and you have it. Okay, I think we have just one more question. Question 12. Okay, question 12 is quite interesting. It says, can the camera look here?
Yes.
Is it possible? Okay, here we go. 12 says, assume the multiplier has a value of 3. Now assume the government decides to increase aggregate demand in an attempt to reduce unemployment. So they're trying to increase aggregate demand to reduce unemployment. It raises government expenditure by 100 million pounds with no increase in taxes. Firms anticipating a rise in their sales increase investment by 200 million. So that's a multiplier. Of which 50 million pounds consists of purchases of foreign machinery. How much will national income rise? Assume no other changes in injections. I'll just take that again. Assume the multiplier has a value of 3. Now assume the government decides to increase aggregate demand in an attempt to reduce unemployment. It raises government expenditure by 100 million pounds with no increase in taxes. Firms anticipating a rise in their sales increase investment by £200 million, of which £50 million consists of purchases of foreign machinery. How much will national income rise, assume no other changes in injection? Okay, this is very interesting. What do we know? The government increases expenditure by 100 million. So we're looking at injections, right? Okay. So government increases by 100 million, okay? And then what happens to firms? Firms also increased by 200 million, okay? But out of this 200, they're giving out 50, right, to other companies in other countries. So 50, okay? It's all in millions, right? So, okay. And then what else? Right? Is that it? I think that's it. Yeah. Okay. Yeah. So what does that give us? So this is injections would rise by 100 M plus 150 M. Okay. So injections would rise by 250 million. Okay. And then we are told the multiplier has a value of 3. So the multiplier has a value of 3. Okay. There we had 5, but here we have 3. So multiplier is 3. Okay. So all we have to do is multiply 250 by 3. Okay. So that's how much national income would rise by, because our injections are 250 million. So to get the national income rise, we'll have to do injections times multiplier effect. Okay, and this is simply 250 million pounds, okay, times 3, okay, and this will just give us 750 million pounds. That is by how much our national income would rise by. Okay, ladies and gentlemen, it's been fantastic being here with you. We hope you've enjoyed it. See you around and be good.